The Fed just reset the entire stock market. Rates are unchanged. There's strong projections, but mixed signals on what is actually happening in the labor force. And we're seeing a softening of the markets and a lot of fear build up. So we're going to discuss all that today. Make sure you stay all the way till the end. I have some stocks that I'm picking, and I'm going to discuss those and some different market analysis. But with that being said, let's start off by actually watching this video by CNBC. Here
we go. This is Fed Chair Jerome Powell taking the podium.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate, and I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year, and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7%, and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. From last September through December, we lowered our policy rate 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate.
Okay, then he's going to finish off with a couple other things. We're not going to watch all that, but wow, there's a lot to unpack there. So we're going to start by unpacking it here one piece at a time. Let's go ahead and look at where everything's at today. So VIX at 25, as you can see on the day. If we look at bonds, they went back up here to 4.2 on the 10-year Treasury. Oil, it's come down a little bit more. Gold, silver, those are all down. Crypto as well, down pretty heavy. So S&P right now, we're seeing quite a bit of red. And the reason why is markets are nervous about this. We could very much see a rate hike when most of us were expecting a rate drop here. If my computer loads. Most of us will experience a rate drop, especially maybe 2 meetings from now. And now we might not even see that. So the market is not happy at all with this, as you can see. Speaks for itself. Apple down 1.5%, Nvidia down almost 1%, Google, Alphabet, Microsoft almost down 2%, Meta another 1.2% today. So that's like 10% in 2 days. And let's look at the fear and greed sector here. So it's at 18, then VIX obviously at 25. So it's gone back up since yesterday. So a lot to unpack. Let's start out by this. So rates remain unchanged and could potentially be hiked, which is exactly what we didn't want to hear. And there's also some news with the Fed chair on how this might be switching over. So the markets are a little bit confused here. So here's the big picture. The Fed held rates steady, but there were strong economic projections. But messaging turned uncertain plus slightly bearish because in January, things were going in a good direction. Then February, once you got that jobs report, it was really bad. And so what Jerome Powell is saying essentially is, well, because you had a good month and a bad month, it essentially means that we're equal. And you guys shouldn't be too worried about it. We might raise hikes, but don't be too worried. And that's why markets are reacting not so well. So the Fed fund rate was stable at around 3.6%, GDP revised up, so around 2.4% expected GDP growth, which is really good. Unemployment is stable, and he pointed out the main reason to that was because of the immigration policy. So if a lot of illegal immigrants are working in the labor force and they obviously get deported, so there's less labor. But we're also seeing less of the construction, but we're going to get into later something that's very, very important with the labor statistics. So stay tuned for that. And then inflation, a slight increase, 2.5 to 2.7, primarily in the goods sector. So because of those tariffs. So there's no stagflation fears, which is good. And then the overall bullish setup at first until he kept going into it. So this is why the markets didn't rally. The problem here is the Fed hinted they almost ignored the projections. So he was like, we have no conviction. So this killed confidence very early in that meeting. Labor markets, there was a subtle but important change. Labor markets stabilizing. And then now he's saying labor markets, little changed. So here was the vote from the Fed. Internal Fed signals 11 votes to hold. And there was only one vote to cut, with some indications that rates actually might be going up. So more of a hawkish shift. Some members now considering hikes. So definitely not what we wanted to hear. Powell's big message, though, was a dual risk warning. So inflation risk high because there's higher oil prices, as we've seen with the conflict in Iran. And then the second piece was the tariffs causing some inflation on the goods sector. Even though the tariffs have been canceled, they didn't liberate us, not quite. That's still going to have impacts, and we're seeing that in the market and economy right now. There's a little bit of a slowdown. So this opens the door for rate hikes again. Now, rate hike talks return with Powell confirming that rate hikes were discussed. And he said they might come not next meeting, but maybe the meeting after, which isn't good for the markets because a lot of people were expecting the new chair to come in, the new federal chair, and then for him to immediately possibly have rate cuts, which would be super great in the summertime for markets to start rallying. And we're seeing quite literally the opposite. He said potentially next meeting or the meeting after rate hike. So even if not base case, it's still on the table. So markets did not like this at all. And here's the inflation problem. There's no progress. So core inflation is not improving. Core of goods inflation rising. There's no progress equals no rate cuts. Why rate cuts are delayed is very simple. What needs to happen is core goods inflation must fall. And then right now it's currently increasing. And typically how they measure these things is they'll look at the market over 5 years and say, for us to have rate cuts, we need to have stability over many checkpoints. So maybe 2-3 years. Now we've had COVID, and then we've had the Ukraine-Russia conflict, and we've had the Iran conflict, then we've had Liberation Day, tariff conflict. And so there's a bunch of these things that keep happening that are ruining, completely destroying the state stability and the chance that rate cuts will happen because things have not stabilized. There's so many new issues and conflicts. Now, obviously, change isn't always a bad thing, but in terms of rate hikes, it is a bad thing, and it is very strongly considered. So AI into the talk. It's very important to discuss this as well, and we need to talk about what's happening with CapEx. So a lot of the companies are spending billions and billions of dollars on CapEx, infrastructure, data, AI centers, as well as just in general building lots of infrastructure. AI is actually and might be causing some inflation because if there's less supply of goods and there's higher cost of oil and less labor, that causes inflation. So examples of this are energy demand, chip prices, labor and construction. So really just a short-term inflationary thing. Now we might see some deflation happening over the next 2 years once all this is done, but we're in a time where that's not happening. Here's the global risk that we have to talk about. So external pressures from the Middle East tensions, oil supply risks, and then repeated inflation shocks over the past few years, like we discussed from COVID, the Ukrainian conflict with Russia, that obviously spiked oil as well. So it's very similar here. So inflation might be a little bit more sticky here. We might have to bring down inflation, which is why they would hike rates. So the bond market reaction, we did look at that. The 10-year yield and the 2-year yield went up even more. So higher rates for longer. And then here's the stock market reaction. So good data, nope. Rate hike talk, absolutely not. And uncertainty, yes. So it's more of a bearish sentiment as it takes over. And this is why it's important. If you guys are enjoying this, by the way, just leave a sub down there. That's why it's so important to learn different strategies in the market, because we might be going into a bearish situation where there's a kangaroo market. So nothing happens for a year or two. Or it could be like 2022, where we just slowly slide and slide deeper and deeper until we hit the bottom 11 months later and we come out of that recession. Okay. So with the bearish sentiment, you have to stay up to date on the VIX, the fear index. And this is obviously everything we talk about here. So click subscribe to stay up to date. But really, really understand how the market works. Because if you go spend all your cash deploying it into a company because you think that's the bottom, well, we're not sure. Like if we see rate hikes, it will definitely go lower. The market won't react nicely. So Powell staying longer. So this is really important. We have to discuss this. So Powell may remain longer than expected, dependent on replacement confirmation. Markets wanted that change of the Fed chair, and we got uncertainty instead. Key takeaways of this is what investors should know. There are no rate cuts happening soon. Rate hikes are still possible. Inflation is still a problem, and AI is not reducing inflation yet. Now, there might be a situation that might occur where Jerome Powell stays as the Fed chair for a year, maybe even a little bit longer, maybe a year and a half. And so that would drastically affect the markets as well and the sentiment going forward. Yes, we would get through that, but there would be a slight dip most likely in the markets. So here's my final verdict here before we look at some special stock news and some sentiments that I'm currently buying. Is it bullish or is it a bearish sentiment? Short term, we're looking at a bearish sentiment. That could be the next month, 2 months. But long term, it depends on inflation. If we can really bring that inflation under control and get into a rally point, I think we're in a really good spot to take off here. There's lots of good things happening across the software sector, AI. Those changes have been a lot more adapted within those companies. There's less fear with Anthropic. And I think we can be going into a really good situation of a bull run here. Now, let's look at the S&P here on the day. I know it was sliding quite a bit, but it's still around the support level. So people are still holding their breath. Still a lot of tension here. If you look at the 6-month chart, it's just holding at that support, just holding at the 6,700. But a company I am buying right now is actually Palantir. So I think this is a fantastic buy. I'm holding my Palantir until it hits 450, 500. I'm not getting rid of mine. I absolutely love this company. So as you can see, we had a little bit of a recovery over the 5-day period. You can tell people are catching on that, oh my gosh, Palantir actually, it's got some strong fundamentals regardless of what's happening in the market. This is such a good company to hold long-term, swing trade as well as options trade on here. But with that being said, if you guys enjoyed the video, make sure that you leave a like. Let me know your thoughts down below of how you think this will affect the market and what videos you guys would like for me to come out with next. But with that being said, we'll see you guys next time. Peace.